What if everything you think you know about silver is wrong? What if the $117 price you're seeing right now isn't the top of a speculative bubble, but the bottom of a systemic collapse? I'm about to show you why 25% tariff bombshell on South Korea isn't just another trade dispute. It's the first crack in a dam that's been holding back the greatest precious metals repricing of our generation. And if you think you've missed the move, you're about to discover why the real explosion hasn't even started yet. I'm recording this Tuesday, January 27th, 1:30 p.m. New York time. Drop a comment with what time you're watching. I want to see who's catching this live versus who finds this after the market has already moved. And if you've been watching these breakdowns without subscribing, today's the day to change that. What I'm about to reveal could redefine how you think about wealth preservation for the next decade. Here's what most analysts are getting catastrophically wrong about Trump's South Korea tariff. And I mean catastrophically wrong. They're treating it like a trade negotiation. It's not. This is economic warfare, and South Korea wasn't chosen randomly. It was chosen strategically, deliberately, to send a message that most people aren't equipped to hear yet. South Korea sits at the nerve center of the global supply chain: semiconductors, advanced batteries, shipbuilding, electronics manufacturing. When you hit South Korea with a 25% tariff, you're not just affecting one country, you're detonating a charge at the foundation of global commerce. This isn't about punishing Korea. This is about reminding the entire world who controls access to the largest consumer market on the planet and what happens when that access becomes a weapon. The ripple effects are already in motion. Right now, at this very moment, procurement officers across 3 continents are sitting in emergency meetings, asking themselves the same terrifying questions. Can we absorb this cost? Do we pass it on? Do we relocate production? Do we stockpile now before it gets worse? And here's the question that should keep you up at night, the one that changes everything. What if this is just the beginning? Because history has a clear message for anyone willing to listen. Tariffs never stay isolated. They metastasize like a disease. They trigger retaliation. They provoke countermeasures. They fracture trust in the stability of trade relationships that everyone assumed were permanent, relationships that global commerce has been built on for decades. And when that illusion breaks, when people realize the rules can change overnight, capital moves fast, violently fast, toward assets that exist outside the system of promises and political leverage. That's where silver enters the frame, not as speculation, not as a gamble, as survival, as the ultimate diagnostic signal that something fundamental is breaking in the architecture of the global economy. Tariffs don't just raise prices, they scramble planning horizons. They inject chaos into systems optimized for predictability. Manufacturers that relied on just-in-time delivery suddenly can't rely on it anymore. Supply chains optimized for cost are forced to prioritize security overnight. That transition phase is chaotic, and chaos always increases demand for hard inputs that can't be conjured digitally or hedged away synthetically. Silver, sitting at the intersection of industrial necessity and monetary refuge, becomes one of the first pressure valves. This is why the tariff functions as a warning shot that echoes across every market. It signals that we are no longer in a globalization regime built on cooperation, but one built on leverage and coercion. And leverage changes behavior instantly. When nations use trade as a weapon, every participant starts looking for insulation. Currencies become volatile, counterparty risk rises, long-term contracts lose credibility. In that environment, assets that exist outside the balance sheet web gain strategic importance very quickly, and I mean within days, not months. Markets have seen this movie before, and the ending is always the same. Trade friction in the 1930s preceded monetary breakdown. Trade fragmentation in the 1970s coincided with precious metals repricing that destroyed people who were on the wrong side. Even in the post-2008 world, every serious flare-up in global trade tension has preceded sharp moves in gold and silver. Not because metals love inflation, but because they respond to confidence fractures before the damage shows up in official data, before the headlines catch up, before most investors even realize what's happening. So when silver starts reacting to a tariff announcement, it's not guessing, it's not speculating. It's front-running the second and third order effects that equity markets will only acknowledge months later when it's too late. The tariff says supply chains are political now. Silver says then money has to be real again. This is why dismissing the tariff as just another negotiation tactic misses the point entirely and leaves you dangerously exposed. The market doesn't care about intent. It cares about precedent. And the precedent being set right now is that trade is unstable, alliances are conditional, and economic security is becoming national security. That is not a backdrop where silver drifts sideways. That is a backdrop where silver reasserts its role as both an industrial necessity and a monetary escape hatch. And it starts doing so long before the headlines catch up, long before CNBC tells you it's happening. For decades, silver was treated as gold's volatile little brother, something to trade, something to speculate on, something that moved fast but ultimately followed the monetary lead of bigger forces. That framing is now obsolete, and clinging to it will cost you dearly. Silver has crossed a threshold where it can no longer be understood through the old precious metal lens alone. It is no longer just a store of value. It is a structural input to the modern economy. And that changes everything. I mean everything about how it behaves when stress enters the system. Unlike gold, silver is not hoarded and forgotten in some vault. It is consumed, devoured by industry. Once it goes into a solar panel, a circuit board, a battery contact, or a military guidance system, it doesn't come back to the market in any meaningful time frame. That means the silver market is constantly balancing on a knife's edge between available supply and industrial draw. When conditions are calm, that tension is invisible. When conditions tighten, even slightly, the imbalance becomes explosive and violent. What makes this moment different, what makes this moment historic, is that silver's industrial role is no longer marginal. It sits at the core of energy transition infrastructure, advanced electronics, and defense manufacturing. These sectors are not optional. They are strategic priorities for governments and corporations alike. And when tariffs, trade friction, or geopolitical risk threaten supply continuity, these buyers don't wait for price signals from futures markets. They secure material first and ask questions later. They don't care if they overpay because the alternative is catastrophic. That behavior bypasses paper pricing mechanisms entirely. This is where most investors misread silver and set themselves up for devastating losses or missed opportunities. They assume price discovery happens primarily in futures markets, guided by macro narratives and interest rate expectations. In reality, physical silver is increasingly being pulled by end users, whose primary concern is not yield but continuity of production. When an EV manufacturer or a solar supplier faces potential disruption, paying a higher price for silver is infinitely cheaper than shutting down a production line. That logic breaks the traditional relationship between price sensitivity and demand. At the same time, silver retains its monetary identity. It has thousands of years of history as money, as settlement, as a hedge against debasement and systemic risk. That history matters because in moments of instability, markets don't invent new safe havens. They revert to old ones. They return to what worked when empires fell, when currencies collapsed, when trust evaporated. Silver's dual nature, industrial necessity and monetary metal, means it absorbs demand from both sides simultaneously. Very few assets in the world do that, and none of them are priced as tightly as silver is today. This dual demand creates a structural asymmetry that most analysts completely miss. When confidence is high, silver grinds sideways and people forget about it. When confidence cracks, silver gaps violently upward and leaves people behind. Industrial users don't sell when prices rise. They buy more aggressively because their fear intensifies. Monetary buyers don't care about fabrication demand. They care about trust in the system, or the lack of it. When those two forces align, when industrial panic meets monetary fear, supply doesn't just tighten, it disappears. And because above-ground silver inventories are far smaller than most people assume, far smaller than what the comfortable narratives suggest, the adjustment happens through price, not volume, violently through price. The paper market has masked this reality for years by offering the illusion of abundance. Leverage, rolling contracts, and cash settlement have allowed enormous notional supply to trade without corresponding physical movement. But industrial demand doesn't settle in cash. Neither does sovereign accumulation. When real silver is required, paper promises are irrelevant. They're worse than irrelevant. They're exposed as the fraud they always were. That is why dislocations show up first in premiums, delivery delays, and backwardation long before they show up in headlines, long before mainstream media tells you to pay attention. This is also why silver reacts so violently to macro shocks. It is not just reacting as a hedge against inflation or currency debasement. It is reacting as a material whose strategic importance is rising at the exact moment its supply chain is becoming more fragile. Tariffs, trade wars, and geopolitical fragmentation don't just boost silver's appeal as money, they stress the industrial system that depends on it, creating a feedback loop that accelerates price discovery. In this environment, calling silver just a precious metal is like calling oil just another commodity during an energy crisis. The label understates the role and blinds you to what's really happening. Silver is now a critical input and a monetary escape valve at the same time. And when markets finally internalize that reality, when that light bulb goes on for institutional money, silver doesn't reprice politely. It reprices abruptly, shockingly, because the old models no longer apply and everyone realizes it at once. Most people look at silver hitting $117 and assume they already missed it. That reaction alone tells you how conditioned investors have become by years of artificial suppression and sideways pricing. In reality, $117 was not the speculative blow-off. It was the market finally lifting its head above water after being held down for far too long. What looks like a peak to the untrained eye is structurally a foundation, and foundations are what the biggest moves are built on. For years, silver traded in a range that made no sense relative to monetary expansion, industrial demand, or geopolitical risk. That disconnect wasn't accidental. It wasn't the market speaking. It was the result of a paper market that allowed massive leverage to dictate price while physical realities were deferred, ignored, suppressed. When silver finally pushed through long-standing resistance and held, it wasn't enthusiasm driving the move. It was exhaustion. The system simply ran out of selling pressure that wasn't backed by real metal. That distinction matters more than anything. Markets driven by hype, spike, and collapse. Markets driven by structural resolution behave very differently. When silver reached $100, it didn't immediately reverse like a speculative bubble should. It consolidated. It absorbed selling. It refused to give back ground, even as commentators called it overextended. That is classic base building behavior, not topping behavior. It signals that ownership has shifted from weak hands to stronger ones with longer time horizons and deeper pockets. A base is formed when price finally aligns with reality. At $117, silver began reflecting a world of higher input costs, tighter supply chains, and rising geopolitical stress. Importantly, it did so without the retail frenzy that usually accompanies late-cycle moves. That tells you this was not driven by euphoria or social media hype. It was driven by revaluation, by cold calculation. The market was quietly admitting that the old price regime no longer made sense. Once a base is established under stress conditions, the next move tends to be fast and nonlinear, and I'm talking about moves that happen in days, not months. That's because resistance above has already been cleared while new demand continues to build underneath. In silver's case, that demand is coming from multiple directions at once. Industrial users locking in supply, sovereign and institutional players hedging instability, and investors slowly realizing that silver is mispriced relative to its role in the system. When those forces stack, when they all converge at the same moment, the market doesn't grind upward. It jumps, it gaps, it leaves people behind. This is why historical comparisons are so important and so terrifying if you're not positioned. Every major silver repricing in the past followed the same pattern. Long periods of suppression, followed by a sharp breakout, followed by a pause that convinces people it's over. Then comes the real move, the move that makes fortunes and breaks those who waited. In the late 1970s and the early 2000s, and even in the post-2008 environment, silver never exploded from the first breakout level. It exploded from the base formed after the breakout, when complacency returned briefly and supply failed to respond. The math here is not complicated, but it is uncomfortable for those anchored to old price expectations. A 15 to 20% move from a properly formed base during a period of macro stress is not extreme. It is normal. It is expected. In silver, given its thinner market and higher volatility, it is conservative. From $117, that range places $135 directly in the crosshairs, not as a stretch target, but as a natural continuation of the repricing already underway. What makes this setup particularly dangerous for skeptics is timing. Bases don't announce when they're complete. They don't send you an email. They end when the market runs out of patience. Often the catalyst looks trivial in hindsight. A tariff headline, a delivery issue, a currency move that happens too fast. The move itself feels sudden, but structurally it was inevitable. All the pressure was already there waiting for release, like a coiled spring. So, when people ask whether silver can really move from $117 to $135, they're asking the wrong question entirely. The correct question is whether the conditions that created the base have been resolved. They haven't. Supply is still tight, demand is still rising, confidence in the global system is still eroding. Until those variables reverse, $117 remains a floor, not a ceiling. In that context, $117 will likely be remembered the same way past breakout levels were remembered, not as the high, but as the last chance to buy silver before the market stopped pretending it was cheap. One of the biggest mistakes investors make is assuming tariffs are primarily an inflation story. That's a surface-level read that misses the real danger. The deeper impact of Trump-style tariffs is not higher prices at the checkout counter, it's currency instability, and currency instability is where fortunes are destroyed. Tariffs don't just tax goods. They disrupt capital flows, distort trade balances, and force foreign exchange markets to reprice risk very quickly. And silver historically responds first to that kind of disruption, faster than any other asset class. Trump's economic playbook has always been asymmetric and aggressive. Markets remember this, even if they try to pretend they don't. Policy under this framework is not gradual, not telegraphed, and not constrained by diplomatic niceties. That unpredictability is poison for currency stability. FX markets thrive on continuity and expectations. When policy shifts can arrive overnight and at scale, those expectations fracture and volatility rushes in to fill the gap. A 25% tariff doesn't exist in a vacuum. It immediately raises questions about retaliation, renegotiation, and escalation. Will the affected country weaken its currency to offset the tariff? Will capital flee to safer jurisdictions? Will trade partners diversify away from dollar settlement to reduce exposure? These are not theoretical questions for some future seminar. They are the first calculations made by central banks, sovereign funds, and multinational corporations when tariffs hit. And those calculations move currencies before they move goods, before they show up in trade data, before economists write papers about them. Dollar volatility is especially important here because the global system is still dollar-centric, but increasingly uncomfortable with that reality. The dollar is used everywhere, but trusted less than it used to be. When tariffs are used as a policy weapon, they remind the world that dollar access is conditional, that it can be taken away. That creates a paradox. Short-term dollar strength driven by capital flight, followed by medium-term instability as alternatives are explored. Silver thrives in that transition phase when confidence erodes, but a replacement system hasn't yet emerged. Historically, silver performs best not when the dollar is weak, but when the dollar is unstable. Sharp moves, conflicting signals, and sudden reversals create demand for assets that sit outside the FX system entirely. Silver doesn't belong to any central bank. It doesn't carry policy risk. It doesn't require a counterparty to honor a promise. In moments where currencies behave erratically, those characteristics become valuable very quickly. Trump-era tariffs also amplify a lesser-discussed phenomenon that's absolutely critical to understand: hedging urgency. Corporations exposed to global trade don't hedge gradually when volatility spikes. They rush, they panic. Currency hedges, commodity hedges, and balance sheet protection all get adjusted at once. That surge of defensive positioning pushes capital toward hard assets, especially those with deep liquidity and historical credibility. Gold absorbs some of that flow, but silver often reacts more violently because its market is smaller and its pricing more distorted by paper leverage. Another critical factor is speed. Traditional macro stress unfolds slowly enough for markets to adapt. Trump-style policy shocks compress timelines. Moves that might have taken quarters happen in weeks or days. FX desks don't wait for confirmation. They respond immediately. When currencies start moving faster than models predict, it signals loss of control. That's when confidence cracks, and silver starts trading less like a commodity and more like an insurance asset. It's also important to understand that tariffs can weaken the dollar even when headlines suggest strength. A rising dollar driven by fear is not the same as a stable dollar driven by confidence. The former is fragile. It invites intervention, policy responses, and political backlash. Silver doesn't care why the dollar is moving. It cares that the movement reflects stress rather than growth. In those conditions, silver tends to front-run the realization that currency stability is eroding beneath the surface. This is why silver reacts to tariff headlines even before inflation data, earnings revisions, or economic indicators shift. It's responding to the currency layer of the system, the layer that transmits shock faster than any other. When tariffs inject uncertainty into that layer, silver prices it in immediately, not because traders are guessing, but because the metal has centuries of history responding to monetary disturbance before it becomes visible elsewhere. So when Trump-style tariffs re-enter the equation, the takeaway is not simply higher costs or slower trade. The real takeaway is this, and listen carefully. The dollar is about to move in ways that make people uncomfortable. And when discomfort replaces confidence in currency markets, silver doesn't ask for permission. It reprices. At the heart of the silver market lies a contradiction that only becomes visible during periods of real stress. Most of the silver that trades every day doesn't actually exist in deliverable form. Paper silver, futures contracts, unallocated accounts, derivatives, and synthetic exposure has worked for decades because the system relied on one assumption above all others, that most participants would never ask for the metal. Trade wars threaten that assumption directly and brutally. A trade war changes behavior. It shifts priorities from efficiency to security, from price optimization to supply certainty. Industrial users don't care how elegant the paper market is when their production lines are at risk. If tariffs, sanctions, or geopolitical escalation threaten supply chains, those users start demanding physical control over inputs. In silver's case, that means delivery, not cash settlement. And the moment enough participants make that shift simultaneously, the paper market's weakness is exposed for all to see. The paper-silver market is built on leverage. For every ounce of silver that can realistically be delivered, there are many more ounces promised on paper. Under normal conditions, that imbalance is invisible because contracts are rolled, settled financially, or offset before delivery ever becomes an issue. But trade wars are not normal conditions. They create urgency. They compress timelines. They turn theoretical risks into immediate operational problems. That is when paper promises are stress tested, and most fail that test. History shows that commodity markets behave very differently when physical demand asserts itself. Price no longer reflects marginal trading activity. It reflects scarcity. In silver, scarcity doesn't show up first on charts. It shows up in the plumbing of the market. Delays, rising premiums, shrinking inventories, widening spreads between physical and paper prices. These signals are easy to dismiss until they're impossible to ignore, and by then, it's too late to position yourself. What makes silver especially vulnerable is that it serves two masters at once. Industrial demand requires physical delivery, while monetary demand seeks protection from systemic risk. During a trade war, both demands rise together. Industrial users are forced to secure supply ahead of disruptions, while investors seek assets that sit outside the trade and currency system. That convergence places extraordinary pressure on a market that has been priced as if supply were elastic and abundant. Paper silver cannot respond to that pressure by producing more metal. It can only reprice, and violently. When delivery requests rise, exchanges and intermediaries have limited options. Incentivize cash settlement, restrict contract terms, or allow prices to rise sharply to discourage demand. All three outcomes undermine confidence in the paper system itself. Once confidence is questioned, participation changes. And when participation changes, leverage collapses quickly and painfully. Trade wars accelerate this process because they politicize supply chains. Silver used in electronics, energy infrastructure, and defense applications becomes strategically sensitive. Governments and corporations begin to treat it less like a tradable commodity and more like a critical resource. That mindset is incompatible with a market structure where most exposure is synthetic. The mismatch becomes obvious, and markets hate obvious mismatches. Another critical element is geography. Much of the world's physical silver demand sits outside Western financial centers. Asian buyers, in particular, tend to prioritize physical ownership over paper exposure. When trade tensions rise, these buyers bypass futures markets entirely, pulling metal directly from refiners and vaults. That drains the system quietly until suddenly there isn't enough inventory left to support paper claims at current prices. This is why silver's biggest moves rarely happen during calm macro conditions. They happen when something breaks trust in the system. A trade war does exactly that. It tells participants that rules are changing, that access can be restricted, and that financial instruments may not behave as expected under stress. In that environment, holding a promise to deliver silver is not the same as holding silver. Once enough participants internalize this difference, the market flips. Price stops being about speculation and starts being about allocation. Who gets the metal and at what price? That transition is not smooth, it's abrupt. And because silver's paper market is so large relative to its physical base, even a small shift in behavior can force a large repricing. This is why trade wars are existential events for paper silver. They don't need to destroy the system outright. They just need to make people question it. When that happens, silver doesn't rise because of hype or fear alone. It rises because the market is forced to reconcile paper claims with physical reality. And that reconciliation has only one historical outcome: higher prices, sudden moves, and a permanent loss of confidence in synthetic abundance. In that sense, a trade war isn't just bullish for silver, it's a reckoning. When people hear a price target like $135, their instinct is to treat it as an endpoint, a level where the move is supposed to end and rationality returns. That instinct is rooted in years of training inside a system where markets are assumed to be orderly, liquid, and self-correcting. Silver does not behave that way once it enters a true repricing phase, and we are in a true repricing phase right now. In this context, $135 is not where the story ends. It's where the market finally admits what has already changed. A confirmation level is different from a speculative target. It's the point at which denial breaks. Below it, skeptics argue the move is temporary, driven by headlines destined to mean revert. Above it, behavior changes. Risk managers adjust models. Institutions that were underweight scramble to rebalance. Industrial users stop waiting for pullbacks and start locking in supply regardless of price. The conversation shifts from, is this real, to how exposed are we? That shift matters more than the number itself. At $135, silver would no longer be dismissed as a volatile trade or a fringe hedge. It would be recognized as an asset repricing in response to systemic stress. That recognition brings new participants into the market, not because they are bullish by nature, but because they can no longer justify being absent. This is how reflexivity works. Rising prices force buying, and forced buying accelerates repricing. What's critical to understand is that confirmation levels tend to arrive faster than expected. Once silver clears a psychologically important threshold, there's very little structural resistance above it. The market has spent years trading sideways, which means there's minimal overhead supply from long-term holders waiting to exit at break-even. Most of that supply has already been exhausted above $135. Price discovery becomes less about technicals and more about urgency. Urgency is the defining feature of late-stage repricing. By the time silver reaches a confirmation level, the conditions that drove it there have not resolved. Trade fragmentation, currency volatility, supply constraints, and confidence erosion do not reverse overnight. In fact, they often intensify. That's why confirmation levels rarely mark tops. They mark transitions from disbelief to acceptance, and acceptance brings scale. Another overlooked factor is narrative alignment. Below 135, silver's move can be argued against using selective data and outdated frameworks. Above it, the narrative starts to align with reality. Headlines change tone. Analysts revise forecasts. Media coverage shifts from dismissive to explanatory. That shift draws in capital that was previously on the sidelines waiting for proof. Ironically, by the time proof arrives, the easy part of the move is already over. This is where availability becomes more important than price. Once silver is confirmed as scarce rather than cheap, buyers behave differently. Physical premiums become sticky. Delivery timelines stretch. Inventory becomes strategic rather than transactional. At that point, price no longer reflects marginal demand. It reflects competition for a limited resource. The competition doesn't resolve itself gently. History reinforces this pattern with brutal consistency. Every major silver revaluation has featured a moment where a widely watched level was breached and then left behind. Not tested, not revisited, left behind. Those moments were not driven by mania. They were driven by realization. The realization that the assumptions underpinning the old price no longer applied. Calling $135 the ceiling assumes that the forces driving silver higher are linear and finite. They are neither. They are systemic and reflexive. Each incremental move exposes more fragility, attracts more defensive capital, and tightens the physical market further. That feedback loop does not stop at round numbers. It doesn't care about your charts or your price targets. So when silver approaches $135, the important question won't be, should we sell? It will be, what does this price now signal about the system we're operating in? And the answer will be uncomfortable. It will suggest that monetary confidence is weakening, trade stability is eroding, and physical assets are being repriced to reflect real risk, not theoretical models. In that sense, $135 is not a destination. It's a message. A message that the era of suppressed pricing and synthetic abundance is ending, and that silver is once again being treated not as a side bet, but as a core signal of systemic stress. Once that message is received, the market doesn't go back to sleep.